$58 trillion. That is how much wealth was wiped off the face of the earth between 2007 and 2009. More than the entire global GDP. Gone. And for years, the official story was simple. A housing bubble formed. It popped. Nobody saw it coming. Terrible luck. Moving on. But here is what they did not tell you. 3 companies saw it coming. They watched it being built, brick by brick, bad loan by bad loan. They understood exactly what was inside the machine. And instead of raising the alarm, they stamped it. AAA, the highest possible safety rating a financial product can receive. They told the world this debt was as safe as lending money to the United States government. They lied. And when the machine exploded and took the savings, homes, and jobs of 50 million people with it, not one of them went to jail. This is not a story about a bubble. This is a story about a crime that was dressed up as a mistake. To understand what happened, you need to understand one simple idea. Banks used to care if you paid them back. For most of history, when a bank gave you a mortgage, it kept that loan on its own books. If you stopped paying, the bank lost money. So banks were careful. They checked your income. They verified your job. They asked hard questions. Then Wall Street figured something out. What if we did not have to keep the loan? What if we could sell it? Here is how it worked. A bank gives you a mortgage, but instead of holding it, it bundles your loan with 1,000 other mortgages and sells the whole package to investors as a bond. The bank gets its money back immediately. The investors collect the monthly payments, and the bank moves on to writing the next mortgage. Simple, clean, and on the surface, not crazy. The problem was what happened next. If you are a bank and you no longer keep the loans you make, you no longer care if those loans are repaid. Your job is not to lend carefully. Your job is to lend volume. So standards collapsed. By 2005, banks were handing out mortgages with no income verification, no down payment, and adjustable interest rates that would double in 2 years. They called these loans exotic. The polite term was subprime. The honest term was unpayable. One product became infamous, the ninja loan. No income, no job, no assets, approved. A strawberry picker in California earning $14,000 a year was approved for a $720,000 home loan. A McDonald's employee making $8 an hour bought 3 investment properties. A man who had been unemployed for 6 months was handed a $400,000 mortgage without a single document being checked. And the banks did not care, because by the time those loans defaulted, they had already sold them. To who? To the machine. This is where the story gets dark. The mortgage bonds being sold to investors around the world were complex. Thousands of loans bundled together, sliced into layers, repackaged, renamed, and sold again. Nobody buying them had time to look inside every single loan. They needed someone to tell them whether it was safe. That job belonged to the credit ratings agencies. Moody's, Standard & Poor's, Fitch. 3 private companies with one public function. They were the referees of global finance, the guardians of trust, the organizations whose entire reason for existing was to give investors an honest assessment of risk. And here is the problem. They were paid by the banks whose products they were rating. Read that again. The banks paid the referees. This arrangement had a name, Issuer Pays Model, and it created the most catastrophic conflict of interest in the history of modern finance. Here is how it played out. A bank builds a bond packed with subprime mortgages, loans to people who cannot afford them, debt that is almost certainly going to default. The bank walks into Moody's and says, "We need a rating on this." Moody's has a choice. It can look inside the bond, see the garbage, and give it the rating it deserves, junk. Or it can give it a AAA rating, collect its fee, and keep the client happy. If Moody's gives it junk, the bank walks across the street to Standard & Poor's. If S&P gives it junk, they walk to Fitch. And whoever gives the highest rating wins the contract. This was called ratings shopping, and every agency knew it was happening. Internal emails, later recovered by congressional investigators, made this explicit. One analyst at S&P wrote to a colleague in 2006, "Let's hope we are all wealthy and retired by the time this house of cards falters." They knew. A Moody's analyst said internally that the firm would rate a deal structured by cows if it paid the right fee. They knew. A senior S&P manager was shown a presentation by his own analysts warning that the housing market was deteriorating rapidly. His response was to shelve the report and instruct the team to keep issuing AAA ratings. They knew, and they stamped it AAA anyway. Between 2000 and 2007, Moody's rated nearly 45,000 mortgage-related securities. Over 80% of them received AAA, the highest possible rating, safer than most government debt. By 2010, 73% of those AAA-rated bonds had been downgraded to junk. Junk is not a minor adjustment. Junk means the thing is almost worthless. They gave the financial equivalent of a 5-star review to a restaurant with rats in the kitchen. And the world ate there. Pension funds in Norway, city governments in Australia, school districts in America, insurance companies in Japan. They all bought these bonds because a trusted, century-old institution told them it was safe. They trusted the stamp. The stamp was a lie. In 2006, housing prices peaked. Then they started falling. At first slowly, then fast, then all at once. Homeowners who had borrowed more than their homes were worth began defaulting. First the ninja loans, then the subprime, then the adjustable rate mortgages whose payments had just doubled. The bonds packed with these loans began bleeding, and then the entire system discovered something terrifying. Every major bank in the world was holding these bonds, not because they were greedy, because they had been told they were safe. Bear Stearns, gone. March 2008. Indy Mac Bank, gone. July 2008. Fannie Mae, Freddie Mac, taken over by the U.S. government, September 7, 2008. And then, September 15, 2008, Lehman Brothers, 158 years old, the fourth largest investment bank in America, gone. Overnight, the single largest bankruptcy in human history, $691 billion in assets, vanished. The morning after Lehman fell, the global credit market froze. Banks stopped lending to each other because nobody knew who was holding how much toxic debt. The entire financial system, the pipes through which money flows, locked up. Within days, a run began on money market funds, the kind of account millions of Americans used as a safe place to park cash. Not investments, savings. The U.S. Treasury stepped in and guaranteed them, all of them, because the alternative was unthinkable. The Federal Reserve opened emergency lending windows that had not been used since the Great Depression. Congress passed a $700 billion bailout in 7 days, and still 8.7 million Americans lost their jobs. Nearly 4 million families lost their homes. $11 trillion in household wealth was erased. The ratings agencies that made all of this possible? Moody's stock did fall 73% between 2007 and 2009. But the company survived. It is still operating today, still rating bonds, still paid by the banks whose products it rates. In 2010, the Financial Crisis Inquiry Commission was formed to investigate what happened. After 18 months of investigation, interviewing over 700 witnesses, and reviewing millions of documents, they concluded the crisis was, and this is a direct quote, avoidable. Not bad luck, not a black swan event, not an act of God, avoidable. The commission specifically named the ratings agencies as essential contributors to the collapse. Without AAA ratings, the machine could not have been built. Without the machine, the crisis could not have happened. The Department of Justice eventually settled with S&P for $1.37 billion in 2015. Moody settled for $864 million in 2017. Combined, those fines represented roughly 2 years of combined profit for both firms. Not a punishment, a tax. 0 executives were criminally charged. 0 people went to prison. Compare that with what happened to ordinary Americans. A family in Ohio that bought a home in 2006 because a broker told them it was safe, foreclosed. A teacher in Michigan whose pension fund was invested in AAA-rated bonds that turned to dust, retirement gone. A construction worker in Nevada who lost his job when the housing market collapsed, unemployed for 3 years. They did not build the machine. They did not design the bonds. They did not issue the ratings. They just trusted the system. And the system failed them, deliberately. Here is the part nobody wants to say out loud. Nothing fundamental changed. The issuer pays model still exists. Banks still pay the agencies that rate their products. The conflict of interest that caused the crisis is still the standard business model of global finance. After the crisis, regulators talked about reform. The Dodd-Frank Act introduced new oversight. Agencies were required to disclose more. There were new rules about accountability. But the ratings agencies fought back hard. They lobbied. They litigated. They argued that their ratings were protected as free speech, the same constitutional protection as a newspaper editorial. In 2013, a federal court agreed. Free speech. That is the legal defense of the organizations whose ratings help destroy the global economy. Today, private credit markets, loans made by non-bank lenders, largely outside regulatory oversight, have grown to over $2 trillion. Complex financial products are being built, rated, and sold at volumes that dwarf the pre-2008 era. And the same 3 agencies are stamping them. There is an old saying in finance, history does not repeat, but it rhymes. In 1929, it was unregulated speculation. In 2008, it was unregulated debt. Whatever comes next already has a rating. You just do not know what it is yet. The 2008 crash was not a failure of understanding. It was a failure of honesty. And until we build a system where the referees cannot be paid by the players, we are not watching a game. We are watching a performance. And we are all in the audience. If this video made you think differently about who runs the financial system and who pays for it when it breaks, share it with someone who needs to hear it. And if you want to understand the next crack before it becomes a collapse, subscribe, because the machine is still running.